I think it makes sense, Michael and Jocelyn, to talk about how you come to this space, your interest, your experience. And Jocelyn, why don't we start with you and then we'll go to Michael. So just noting for those that are joining, my name is Jennifer Marietta-Westberg. I'm a principal at Cornerstone Research, and I'm also on the SEC's Investor Advisory Committee. Through my position at Cornerstone and on the SEC committee, I've been working on issues related to SPACs. I have had the privilege of learning quite a bit from Michael and Jocelyn in those contexts. And I know that they have a lot of great information to impart to this audience today. And what we'd like to do, since we have a smaller number, is really make sure that we get to your questions and your interests in this space. So I think we'll start with Jocelyn. Just tell us about your work here and your experience, and then we'll move to Michael next on that point.
Sure, thank you, Jennifer. So my name is Jocelyn Arel, and I'm a partner at Goodwin Proctor. I specialize in technology, company representation, really life cycle representation of technology companies from startup all the way through IPO and eventual exit. I've been in the SPAC space for approximately 16 years, a little bit more than that. I lived through the dot-com boom and bust. And as I started to work on SPAC transactions back in 2004, there were a number of really great companies that came out of the dot-com bubble, but companies really decreased in terms of the rate of their participation in the public markets, and more wealth was being built in the private markets. The four horsemen had exited, had been acquired by other large investment banks. So you really didn't have investment banking focus centered on technology and life science companies. So as I really got to understand and work with SPACs, I thought that there was a lot of value there as a vehicle that could potentially be an alternative to traditional IPOs. There had consistently been a lot of criticism of traditional IPOs, and thought that this may be an avenue to address that. And so for the last 16 or so years, I've been focused, as part of my practice on SPACs, and really, today educating companies in terms of what their alternatives are. Some companies certainly can IPO the traditional way. Others, a SPAC is better suited for them, and still others, it's a direct listing. So that's a bit of my background. But again, I'm a tech and life science lawyer by trade.
Michael?
Great. So my name is Michael Ohlrogge. I'm an assistant professor of law in New York University School of Law, and I study and teach on subjects in banking, finance, financial regulation, bankruptcy, and those related areas. And I've been studying SPACs for about 3 or 4 years now. And I have about a year ago, almost exactly today, released a paper that was called A Sober Look at SPACs. And what that did was to look at this growing SPAC phenomenon, and it showed that there were a lot of misunderstandings that were out there among a lot of people regarding SPACs, in particular that the costs embedded into the SPAC structure were much higher than had been previously recognized, much higher than they were for other routes going public, but they were very subtle and opaque kinds of costs. And so the paper worked to make those more clear. It also questioned some of the notions about transactional benefits of SPACs. There are a lot of people who said that there are certain transactional functions of the SPAC that are impossible to achieve in an IPO or a direct listing, and the only way to achieve them is with a SPAC. And the paper questioned that. Overall, the research found that SPACs have been a very good way for companies to go public. They've done very well for the issuers, for the companies going public. Unfortunately, though, that's been because historically, they seem to be passing their high costs that are built into the structure on to the investors in the SPAC, and that shows up as just consistently pretty poor returns for people who hold shares through the SPAC mergers. So that's been a lot of my research has been focusing on better understanding SPACs, better understanding their costs, and their transactional aspects, and then looking for ways that the SPAC structure and the product might be able to be improved.
Thank you, Michael. And I do encourage the participants, if you have questions or comments, to put them in the chat or to just turn on your video, raise your hand. We're happy to answer those in real time. And I think, Jocelyn, since you have a lot of interesting information sort of setting the stage for the SPAC market, it makes sense to turn to some of your slides. But before we do that, are there any questions or key issues that people want to raise right away that they'd like to discuss in this session? Okay, as I said, don't hesitate to raise your hand or to put the questions in chat. Jocelyn, I will put up your slides now. Okay, are you able to see those?
I can. Thank you. You can flip to the next one.
All right, great.
Sure. So one of the areas that that I thought would be useful was really just to show the trends, the SPAC IPO market trends, and really the significant growth. The SPAC market was already developing and growing before we hit 2000. I think for a lot of people, all of a sudden, it seemed like this new vehicle in 2020. But there was really consistent growth in the SPAC market, really starting back, I'd say, around 2016, and you could see the trend in 2018, 2019, really, really starting to accelerate. Most of the 2020 growth is Q4 of 2020. That's when the market really took off. I think in part because, when we think back and we look at March of 2020, and states starting to shut down because of COVID, people didn't really know what was going to happen in the capital markets generally, and frankly, the economically or just how we were going to be dealing with COVID. And what a lot of us who were practicing in the SPAC market said was that even in volatile markets, well-structured deals could get done and close. I had two transactions, one that signed and the other that filed its registration statement the week of March 17th, when everything was really starting to shut down. Both of those transactions closed in June of 2020. And one, Open Lending, is to date the best performing de-SPAC transaction of all time. So it does prove that there are transactions that can be very successful, for investors, and that in really incredibly difficult and volatile markets, this is a structure when other avenues are not available to companies that is a viable alternative. So we did see significant growth in 2020 as the market started to come back. You also started to see significant growth in the traditional IPO market, which really hadn't happened at these kinds of levels prior to 2020. That growth continued and accelerated into 2021 at a pace that none of us could have anticipated. The first quarter of 2021 is really a blur to me when you just look at the numbers of IPO transactions, and really starting with the de-SPAC transactions that occurred then. So if you move to the next slide. This really shows you the breakdown of what we've been living through in 2021. As I mentioned, the first quarter, we've never seen IPOs at this level, never mind SPAC IPOs at this kind of level. So most of the market activity was really concentrated in that first quarter. April marks an announcement by the Securities and Exchange Commission, a unilateral announcement of a different approach to the treatment of the warrant component in SPACs. As I'm sure most of you are aware, when SPACs IPO, for the most part, they sell a unit, and that unit is comprised of a share of common stock and a warrant to purchase a fraction of a share of common stock. And the SEC reversed, from our perspective, from the practitioner's perspective, 30 years of SPAC warrant accounting treatment through an announcement in April. So that really caused the number of transactions that we had been seeing to really, really tail off. It was tailing off prior to that time, but with that announcement and the subsequent need to file restatements of, almost every SPAC had to restate its financials. Most had to restate their 10Ks, and then and then make changes in their 10Qs. Some of the companies that had gone public through de-SPAC also had to restate their financial statements. So it, obviously caused a huge disconnect in the marketplace, and you really saw a lot of the transactions kind of ground to a halt. There also, with that level of participation in the marketplace and those numbers of IPOs, the SPACs really people really started to look at SPACs even more than they were starting to. And so you really started to see, a lot of other academics. Michael was ahead of the curve, but a lot of other people have weighed in and started to look at SPACs. The SEC has obviously started to dig in and to look at SPACs, and Congress has really done the same. So you started to have congressional hearings around that time. I will say that there was a little bit of a hiatus, but the numbers are starting to come back, and the numbers will be higher. Just if you take out that first quarter, they will be higher than they were in 2019. So it's going to really show consistent growth in the SPAC market. I really would look at 2020, Q4 of 2020 and Q1 of 2021 as an anomaly. And as the SPAC market matures and develops, we're going to see more, I would say, rational numbers of SPAC IPOs with different types of sponsors as the market matures. Can shift to the next slide. Yeah.
One question for you. You've noted that the activity is starting to come back up, but still well below the levels of January, February, March. As you look into the future, and once the firms have been able to address their financials, as you noted for some of the reasons that the SEC came out and spoke about them, do you see the activity going back up to the levels of January, February, March in the absence of the SEC making any additional changes? Or do you think more regulatory certainty may be needed for activity to rebound?
I don't think activity will ever rebound to those levels. I think it was a irrational exuberance and excitement, right? I think people really looked at the structure. They looked at SPAC sponsor returns. People got very, very excited about the structure. I think that there really needs to be a balance between traditional IPOs, SPACs, and direct listings. And if we continue at that January, February, March rate, there are just too many SPACs to take quality companies public.
Interesting. Okay.
So I do think that you will have a steady rate of SPACs, but and we'll get into it in some of the other, in some of the further slides. But I also think that the complexion of the SPAC sponsor is changing as the market matures. And you can see the same trend in the business combinations. Obviously, the business combination, the second step where the SPAC combines with an operating company to take that company public, that's obviously going to lag the IPO. You have to complete the IPO. You have to go out and do the search process to identify appropriate companies to take public. But you can really see the growth in those those transactions. And if you go back and you look at the SPAC transactions in comparison to what we were doing in 2018, 2019, 2020, in terms of traditional IPOs, you're going to see that there's a pretty decent correlation, and this marketplace takes up, represents, especially in tech and life sciences, where you'll see that, a number of these deals are happening. They represent a pretty significant portion of the IPO market. 2021 obviously is higher. 2022, 2023 will be significant years as well, just because of the length of time that SPACs have to find a partner. They have typically a 2-year lifespan to find a partner. So you have this backlog of over 400 SPACs that are in search of companies to combine with and take public, and that's going to drive significant M&A for at least the next, at these kinds of rates, for at least the next couple of years. And this just shows the trends and the fact that there's a little bit of a backlog. That as more and more companies IPO'd, you're seeing the numbers of SPAC transactions increase. You do see a drop off in these numbers, especially in October. I know the month hasn't ended yet, but the redemptions have increased. One of the key aspects of SPACs is really the amount of capital that can be raised by an operating company in connection with the SPAC transaction. And starting in middle of July, redemption started to really increase. And that has resulted in a number of companies who may have signed deals in January, February, March, who are now closing deals, or who closed deals over the summer, not receiving the level of capital that they had anticipated receiving from this transaction, because people redeemed their shares, received cash back, and that by definition reduced the capital that went to the company. So you're seeing a couple of trends here. The PIPE market is challenging, and most of these transactions are done with a PIPE. And redemptions have really increased. So as practitioners, we're spending more time structuring transactions that are going to get done and provide the level of capital required to finance these companies, so that the benefits and the deal that they struck is the same. It's just we need more tools in our toolbox, and we need to be proactive in terms of thinking through different structures to make sure that these transactions close in a way that delivers the capital to the balance sheet of the companies. This really shows you the industry breakdown. This is 2021. It would, unfortunately, I don't have the breakdown from, say, 2019. You'd see the comparison would be that the majority of these SPACs, like 3/4, would have been general. Most of them were sponsored by financial sponsors, and they were just looking for opportunistic transactions. You have so many different SPAC sponsors, private equity firms, venture capital firms, serial entrepreneurs, and others that have entered into the marketplace and have laser focus in terms of their SPACs. And this just shows you what the IPO breakout is. So what people said in their IPO they were going to combine with. Almost every SPAC has a clause that and disclosure that says this is where we're aiming for. But we have the optionality to pursue transactions in different spaces. So if you'll move to the next slide, you can see what's happening this year in terms of what are the deals that are actually getting done. A lot of these SPACs would have been 2020, some 2021, some 2019 SPACs, but you can really see that the bulk of the transactions are in tech, biotech, fintech, and in consumer. And I think as we continue to see this play out, that those are going to be industries where you do see where you continue to see a lot of activity.
So
So
we do have a question, Jocelyn. What industry tends to make particular use of SPACs?
Sure, and I think that this pie chart, it really reflects that. And let me talk about a couple of the industries. First, in biotech and life sciences generally, those companies tend to go public earlier. It's easier for them to finance themselves once they're public. So if the path is long to take a drug to market, and the financing needs are really, really considerable. And what biotech and life sciences companies have found is that they can combine what's called a crossover round. So the typical traditional IPO for a biotech company is they do what's called a crossover round. So it's a late stage round with investors who play both in private companies and in public companies. And they do a final private round. Then those same investors would participate in the company's IPO. The valuation would step up, and then the company would IPO. And those two tend to happen within a 12 to 18 month period of one another. What the de-SPAC lets you do is combine the crossover round with the IPO. And how they do that is, if you look at the biotech focused SPACs, most of them are around $100 million SPAC. That's a typical size of a biotech traditional IPO. But if you look at the pipe sizes, I did a deal that the pipe was close to $300 million. So you're looking at I think in that deal we raised like $425 million for the company, and that allowed the company to get all the way to the next value inflection point, and then it could go out into the capital markets and raise additional capital at a higher valuation. It allows management to really be focused on building the company, as opposed to having to be back into the public markets consistently having to raise capital. So I don't think this is going away from a biotech perspective. Biotech companies have, they've used traditional IPOs, they've done reverse mergers. It's lots of different ways that they've used to go public. So that's one market that really uses this structure. Another area, and it's not industry sector specific, are companies that are really attractive. They may have been around for a long time, solid revenue, EBITDA, et cetera, but they're complicated. They're not easy to explain. It takes longer than the typical roadshow meeting. So having that one-on-one dialogue with investors really is useful to those companies in their process of going public. And you'll see that a lot in fintech. Some of the fintech companies are, what they do is quite complicated. There are other fintech companies that choose to go direct listing and choose traditional IPOs. And so it's not just fintech, but there are lots of businesses that are harder to explain and may not have been that classic banker-backed company that would go public, but there's a lot of value for investors in having that type of company go public. Clearly, tech is a big area. It's been driven by EV. We've all seen the press. There have been some great deals, some not so great deals, some that we won't know for years because they're science projects in early stage growth companies. I would say that those very early stage growth companies are out of favor right now, and what the market and especially the pipe market and fundamental investors are looking for are really solid, still growing companies, but with revenue, with earnings, but that growth aspect. And I'm spending more time with those companies, some of whom have never taken a dollar of venture or PE funds, but have now decided that going public through a SPAC is probably good for the company, and are going down this path. So I hope that answers it. SPACs are not just US. I think a lot of people looked at what was going on in the US markets and looked internally at their, at their own markets. So you've seen initiatives in London, Hong Kong, and Singapore. Both London and Singapore have in fact adopted their rules. Hong Kong's are in process. Seen a considerable number of SPACs in Europe, mainly coming out of the Netherlands and Luxembourg. So really starting the growth there. It's well behind the US in terms of numbers, but I think people are also looking at a lot of the regulatory issues that we're dealing with in inquiries in the US, whether it's, the SEC, whether it's Congress, et cetera, how we're, taking a deep dive and really looking at the product and what needs to happen to it from a disclosure or other perspective to really, take SPACs to that next level. And so I think it's happening in other countries. I think they will really look at what's going on in the United States and learn from what is going on in the United States and how we react and what the regulatory changes end up being, and modify, accordingly. Because you're seeing in Hong Kong, they're talking about potentially not allowing retail investors to participate in SPACs. And then you had the US Congress come out with a proposal to not allow brokers to recommend SPACs to their clients who are not accredited investors. And then you've had a pullback on the potential pullback on initiatives to broaden the definition of accredited investors. So lots of things going on in terms of suitability of SPACs for particular investor segments.
Thanks, Jocelyn. And maybe we just stop here for a moment, turn to Michael for him to talk about some of the introductory information around his research, and then come back to you to sort of look at the regulatory scrutiny and where we're going next with SPACs.
That's great.
Okay, so I will stop sharing so that Michael can share.
Okay, great. Thank you so much. Everyone can see this my slide here? Great. Okay, so this is based on my paper called A Sober Look at SPACs. It's joint with Mike Klausner and Emily Ruan. And Jocelyn was giving some statistics on SPAC growth, and this is a plot that's pretty similar to what she was showing, although maybe just contextualizing it in a different way. So the dark line here is SPAC IPOs as a percentage of total IPOs, and what we see is they've grown very dramatically, which is probably no surprise to anyone who reads the financial news. Certainly lots of discussion around them. And the dotted line is SPAC mergers as a percentage of going public transactions. And so it's asking, of all the companies that go public through a SPAC or through an IPO or through direct listing, what percent are doing SPACs? And it covers 2020 and up through the first half of 2021. I don't think the percentage is particularly different in the couple of months we've had of the second half of 2021. So it's certainly gone up a lot, but I think sometimes when you read the financial press, you think that like SPACs are the only way that companies go public these days, and there's still an awful lot of traditional IPOs happening. But I mean, it's certainly a huge amount of growth. So. As Jocelyn said, a SPAC, it starts its life by conducting its own IPO, but unlike a regular IPO that usually just sells shares, the SPAC sells units, and they're a package deal. They contain both a share and some fractional number of warrants. The number in that fraction varies over time. The most recent ones are about, on average, half of a warrant per unit, but there's a lot of variation over time and from SPAC to SPAC. The warrants are basically these stock options. They're exercisable to purchase shares in the company the SPAC brings public. They're almost always 15% out of the money with a 5-year term. So in addition to those warrants, the SPAC will have a sponsor, as Jocelyn mentioned, and they're going to compensate themselves by giving them 25% of the number of shares that the SPAC sells in its IPO. So if a SPAC does an IPO for $400 million, for instance, the SPAC sponsor will give itself shares worth roughly $100 million. And those are compensation for the services that the sponsor will provide to the SPAC in trying to find a company to bring public and negotiating the merger. Now, an important feature of the SPAC is that at this point of the IPO, 100% of the money that the SPAC raises from public investors is put into a trust. And that trust is really crucial because at the time of the merger, those public investors in the SPAC have the right to redeem their shares. And when they do so, they get back 100% of the money that they initially paid to buy shares in the IPO, plus interest. Furthermore, they get to keep the warrants that they received for free. Now, one of the interesting things about it is that that's a very good investment. And so what I find in my research is investors who buy units in the SPAC IPO and either sell or redeem their shares at the time of the merger earn about an 11.6% annualized return with zero risk of downside loss, because you're guaranteed to get back 100% of your money. So not only is it a good return, but it dominates by far the investors in SPAC IPOs, in the sense that what I also find in my research is that almost 100% of the investors who are buying units in SPAC IPOs are either selling or redeeming their shares at the time of the merger. So these are not people who are buying in because they have confidence in the SPAC sponsor or that they want to own shares in the company that the sponsor will eventually choose to bring public, but they're investors who've discovered, hey, this is a really great deal to buy these units, sell or redeem the shares, and keep the warrants. And within the SPAC industry, there's even a special name for this group of investors. So they're called the SPAC Mafia, sort of a colorful term. And this is a shirt you can buy from SPAC Insider, which is one of the industry leading websites for providing news and data and services relating to SPACs. So the shirt says, "Make us an offer we can't refuse." In other words, give us this amazingly good return from these free warrants with no downside risk. Make it so lucrative we can't help but buy into this good deal. So it would be nice if these really, really high returns with no downside risk that the initial investors are getting, if it could be generated sort of out of thin air. And prior to my research, this seemed to be the dominant understanding. Not everybody thought it, but it seemed like most people thought this was just sort of a clever, trick of financial engineering. And, there was this interesting new structure. As Jocelyn pointed out, it's actually not that new, but a lot of people thought it was new. It was sort of generating these profits out of thin air. What I point out in my research, though, is if you have these investors who are almost uniformly pulling out before the merger, so they're not contributing any money to the merger, to the company that the SPACs bring public, if they're getting such a high return and worth tens of millions of dollars for the average SPAC, then it's got to be coming at the expense of someone, and that someone could either be the company that's going public, or it could be the investors in the SPAC. And what I find in my research, so anyhow, that ties in to, I guess, one of the other points about SPACs that I find, which is that they're a very expensive way to bring a company public. And so there's three main sources of those SPAC costs. One is the compensation to the SPAC sponsor, the promote. Two is the warrants that are given away to the IPO stage investors. Those warrants are basically a cost of renting money to sit around in the SPAC's trust account while the SPAC searches for a target to bring public. And then the third cost are fees that the SPAC pays to bankers. Some of those fees cover the SPAC's IPOs. Some of them cover investment and advisory services, either to the SPAC itself or the target company that it brings public. And after you add up all of those costs, what you see is that SPACs are a much more expensive way to bring a company public compared to a traditional IPO. Depending on how you measure it, we're talking 2 to 3 times as high of a cost in the total transaction. Now, one way to think about these costs I have here is viewing costs as a percentage of the cash the SPAC delivers, or costs as a percentage of post-merger equity of the firm that goes public. Another way to think about them is to think about how much cash the SPAC is actually delivering in the merger transaction for each new share that the target company is in essence issuing. So to give a simplified illustration, I'll just focus on one of the SPAC's costs, which would be the promote that goes to the sponsor. So suppose a SPAC sells 80 shares in its IPO for $10 each and gives 20 shares for free to the sponsor as the promote to compensate them for their work. So initially, then you're going to have a SPAC that has $8 in cash per share. Now, the interesting thing about the transaction is that redemptions, which Jocelyn mentioned, can dramatically change that cash per share. So if you have 50% redemptions, here you're going to be down to $6.67 cash per share. If you have 75% redemptions, you're going to be down to $5 of cash per share. Now, this, of course, simplifies in a couple of ways. It doesn't cover the pipes that can bring money into the transaction and help replace some of the money lost to redemptions, but it also simplifies in only considering one of the SPAC costs. And somewhere between $5 to $7 of cash per share is what I find to be typical for SPACs, both during the period that I covered in my initial study, which was all SPAC mergers from 2019 through the first half of 2020, as well as some subsequent research that I've done that covers SPAC mergers up through September of 2021. Now, even though a SPAC is a very expensive transaction, even though a lot of value is being drained out of it pre-merger from all of these different costs, there's still the question of whether the target companies going public or the SPAC investors are going to bear those high costs. And one of the contributions from my research has been to challenge what had been the prevailing assumption, which was that the target company would always and automatically bear the SPAC costs. Instead, what I show in my research is that who bears SPAC costs is entirely determined based on the terms of the SPAC merger agreement. So to illustrate this, suppose we've got a typical SPAC that has about $5.70 in cash per share. This is the median figure for what I find in my study. It's improved a little bit since then, but not a whole lot. And I'll give some more up-to-date statistics for more modern SPACs towards the end of my presentation. So if you've got a SPAC, it's in fact delivering $5.70 of cash to the target company for each new share that the target is in essence issuing to investors affiliated with the SPAC. Well, if the target company agrees to a deal that gives SPAC investors shares that are worth $10 each, then it's the target company that's borne the SPAC costs. Maybe it's found the transactional or other advantages of the SPAC worthwhile. It likes partnering with the sponsor. It says, hey, I'm willing to give away shares that are worth much more than the cash that I'm receiving. Conversely, though, if the target company gives SPAC investors shares that are worth $5.70 each, then it's the investors who have borne the SPAC cost. They gave up their redemption right to get back $10. And in exchange, they only got something worth $5.70. And what this implies is that we can make an inference of who is bearing SPAC costs based on what we see in post-merger share prices. Now, an interesting thing about SPAC share prices is that immediately after the mergers close, the share prices consistently look pretty good. So this slide here shows returns 1 week post-merger, excess the NASDAQ, and the returns are measured against the redemption price. And so if they're high and positive, it means that investors have gotten something much more valuable than the redemption right that they gave up. If it's negative, then investors have gotten something worse than the redemption right that they gave up. And this covers all mergers that occurred in each year from 2010 up through the first half of 2021. What we see is, at least from 2010 through 2019, the returns on average are about zero. Some years they're a little above zero, some years they're about zero. It seems like investors were getting about an even deal by giving up their redemption right. And if you look at 2020 and 2021, it looks like a fantastic deal. It looks like the target companies going public through SPACs were willing to give away shares, not just worth more than the cash they were receiving, but worth well over $10. So in a lot of these deals that were closing in 2020 and 2021, the average price of the day of the merger would be about $15 per share. So these looked like fantastic deals at the time. Now, one of the interesting things, though, is that when you look further out past mergers, the pattern starts looking very different. So these are returns 1 year post-merger, access the NASDAQ. For 2021, it's returns current as of, I think, October 10th or 15th, so pretty recent. And we see that every single year, the average returns for post-merger investors have been pretty negative compared to what they would have gotten in a market return if they would have invested in a market index. If you look at 2 years post-merger, the returns are even worse. So there's this steady downward trend that seems to be a persistent pattern in the prices of companies that go public through SPACs. Now, I should say, though, that there's a huge amount of variation, and some companies have done very well for their investors that have gone public through SPACs. What I also find is that even though some SPAC costs are very high, other SPACs have much lower costs. And so one of the things I investigate in my research is what kind of a relationship there is between how expensive a SPAC is and how well it does following the merger.
And Michael,
yes,
maybe we just pause here for a minute now that you've gone through some of your initial findings. Jocelyn has comments about the sort of what you see in the current and prior periods, whether that may hold in the future, or any other thoughts.
Sorry, I'll unmute. So with regard to the prior periods, if you look historically at the companies that have de-SPAC'd, I would not put them in the category of the highest quality companies. I mean, there are certainly some exceptions, but this really wasn't a mainstream avenue of going public. So you had a few outliers that had good performance, but I'm not surprised. I wasn't surprised when I read Michael's paper, and I'm certainly not surprised by any of the statistics with regard to the earlier companies. To Michael's point about all SPACs are not created equal, that's absolutely true. There are huge variations in SPACs, and then the related costs associated with them. As Michael's pointed out, the average today is a 50% warrant coverage. There are a lot of SPACs. I would say the majority of the SPACs that I've done are, a fifth or a quarter of a warrant. I did structure the first no warrant SPAC and have worked diligently with newer entry SPAC sponsors to create structures that really align the sponsor's rewards with stock performance, so that the sponsor isn't really making anything on its promote until the shareholders the shareholders see an increase in price as well. So when we're looking, when we're working for companies and we're looking at SPACs, there's just a huge variety in terms of what's out there, and so it's hard to lump them all together. Plus, industry trends. It's not unusual for life science companies, biotech IPOs, or companies who have IPO'd via a SPAC to trade down. There may be that initial excitement when the company IPOs, but then until you have proof of concept, until there's that next value inflection point, an FDA approval, great clinical results, whatever that is, you'll find that they will trade down. So what I would love to see over time is really comparing some of the de-SPACs by industry sector with comparable IPO companies, and seeing how they perform over time and what the actual costs end up being. And what those of us who are practicing are doing is we're working together with SPAC sponsors, with operating companies, with investment bankers to come up with structures that work better. That's a great thing about SPACs, is that they're incredibly flexible, and so you can make adjustments. You can and hopefully what this shows over time is that greater alignment, because what's happening these days is that you're seeing fewer financial players. There are still going to be financial players in SPACs, and some who have done just a fantastic job with their SPAC franchises, but you're seeing more and more fundamental investors enter the space and really partner with companies. And they're not looking just to do the IPO and then get out. They're looking for, long-term commitment to these companies and their overall growth and success. So, I mean, I totally agree with, with the trends that Michael is seeing and is describing. But what would be terrific is really to see analysis on a more granular basis. And I'd really like to see the results 5 years from now of the class of 2020 and class of 2021, because they're just different SPACs than we historically saw.
Thanks, Jocelyn. Those thinking about future research topics is helpful for Michael, but also helpful for the other academics attending this session. So those points are always appreciated. So we'll turn it back to Michael for a bit. And then when you're done, Michael, we'll go back to you, Jocelyn, for kind of looking at the regulatory scrutiny and where SPACs go from here.
Sounds good. Thank you. So as I was saying, you have on average, although a huge amount of variation, you've got this challenge of a lot of value being drained out of the SPAC so that it's delivering much less in cash per share than $10. And what this plot here shows is that on the x-axis, I have the cash in the SPAC per share pre-merger, and the y-axis, I have the post-merger share value measured as of a year after the merger. And what I see is there's a very tight relationship that basically for every extra dollar of cash per share pre-merger, there's an extra dollar of value post-merger. So the slope is 1, and it kind of makes sense that, for every extra dollar that the SPAC is bringing to the merger, the target companies are willing to give shares that are worth an extra dollar more. The challenge, of course, is that, if you're in one of these SPACs that's only delivering $5 or $6 of cash per share, you're going to probably, on average at least, be left with shares that are worth about that much. Now, as Jocelyn said, there is a lot of variation. And in this chart in particular, I have black dots and clear triangles for different types of sponsors. And it's a little bit of an oversimplified definition, but I define a high quality sponsor as one who is affiliated with an investment fund that has at least $1 billion of assets under management, or a sponsor who's a former CEO of a Fortune 500 or a former executive of a Fortune 500 company. And I find that these black dots tend to do a lot better. It's still not amazing. It's at best sort of roughly matching the market return, maybe underperforming a little bit, but they do much, much better than the non-high quality sponsored SPACs, and they have lower costs to start with. And so that is an important component. And it could be that to some extent also these are the kinds of SPACs and sponsors that target companies are willing to hand over shares that are worth more than just the cash that they're receiving. The target will say, yes, I'm willing to give away shares worth more than the cash I received in exchange for getting to partner with the sponsor who's going to help make the venture more valuable. So one other aspect of SPACs is this question of transactional advantages. So a lot of people will sometimes say, well, yes, SPACs are really expensive, but they're worth it because they give amazing transactional advantages that couldn't be accomplished any other way. My thesis is that a lot of the reason target companies like SPACs is because they allow them to pass the costs of the merger off to investors. Or equivalently target companies like SPACs because the SPAC will give them a higher valuation than anyone else will give. So I think that oftentimes can be a driving motivation, but there are these questions about, is there some transactional advantage? Probably the most common thing I hear said about SPACs is that they give price and deal certainty. So a lot of times people will say, the thing about the SPAC transaction is you sign the merger agreement, you're going public and the price. Well, there's a number of reasons why I've found that this doesn't make a lot of sense. First, SPAC mergers can at times fail, although it's not as common these days. Second, what is becoming more common is for SPAC and mergers to be renegotiated with target valuations dropping in response to investor resistance. By far the biggest aspect of SPACs that cuts against these claims of price and deal certainty are the SPAC redemptions. So as I illustrated previously, depending on the levels of redemptions that you have, it can result in a very dramatically different effective price that a company going public through a SPAC is selling its shares for. It could be $8, it could be $6, it could be $5 or less, depending on the redemptions. Now, I should say that if you can lock in a really big pipe deal, then you can indeed get more price and deal certainty. And I think pipes are a really exciting aspect of the SPAC transaction. The strange thing, though, is that sometimes there's a notion that a SPAC is the only way to get a pipe, whereas they are at times included in traditional IPOs. An example of this I like a lot is Endeavor Group Holdings. They did a traditional IPO in April of 2021. So they did about a $5 or $6 million traditional IPO and a $1.5 billion pipe attached to that with the price locked in advance. So it's a really nice way, the pipe, it gives the company going public more certainty that it's going to be able to sell a certain number of shares for a certain price. It's nice from the perspective of the investors. Because they get certainty in the allocation that they're going to get. And I certainly have a lot of investors talk to me about how frustrated they are that they won't get the allocations that they wanted in a traditional IPO. So it's a nice aspect of a going public transaction. They're relatively common in other countries in the form of anchor investors in IPOs. They've been a little less common in the United States. I hope they become more common, particularly in traditional IPOs. My perspective, though, is it's odd to say that the only way to get one is if you give away a lot of free warrants to IPO stage SPAC investors. If you give away a lot of shares to a SPAC sponsor, you can also get one in a traditional IPO. Now, in terms of developments in the SPAC market, this is one of the biggest things that I've heard from people in response to my paper. People said, this time is different. These new SPACs are different than the old ones. And again, there's a huge amount of variation. So there were some good old SPACs, and I'm absolutely certain there's some good new ones. Most of what I do is look at the industry on a whole, on average. So it in no means diminishes that there are some really value-adding sponsors out there. But as Carmen Reinhardt has said, this time is different. More money has been lost to those four words than at the point of a gun. So to give a little bit of an example of the kinds of feedback that I've had from my paper, SPAC Insider, one of these leading industry news sources and data sources, they said in March of 2021, it's become quite common for the financial media to quote statistics saying something to the effect that the past performance of de-SPACed companies is historically not great, and they then want to apply an outdated metric to the current vintage of SPACs that is very much an apples and oranges comparison. For example, there's a paper put out there by Michael Ohlrogge from NYU, which was a great analysis, by the way, but it examined 47 SPACs that merged between January 2019 and June of 2020, which, as we all know, does not capture the current market boom that started roughly in June of 2020. So it's like, oh gosh, I really got unlucky. I ended my sample period exactly when SPACs were getting good, is a lot of what people told me. It was a little bit funny because I'd been studying SPACs for about 3 years at this point. I initially gathered data on all SPAC mergers in 2017 and 2018. And I did that because people back in 2018, when I started, they said, you can't look at the old mergers. You have to look at the new ones. SPACs have turned a corner. You got to look at the 2017, 2018 mergers. So I did that, spent a huge amount of time gathering data on them. Then I was about to write up and publish a paper, but then people say, no, now SPACs have turned a corner. You got to look at the newer ones, the 2019 and 2020 ones. Those are the ones that have turned the corner. So I threw away all the data from 2017 and 2018, gathered new data for 2019 and 2020, then wrote up this paper. And then people are saying, oh gosh, you got it wrong again. And the turning point was exactly at the end of your sample period. And interestingly enough, if you look again at these one-day returns right when these mergers were closing, it did look like I just completely miffed this. And all of these SPACs looked great. So these are the mean and the median returns one day post-merger for each of the calendar quarters after my study came out. So 2020 Q3, Q4, and then Q1 through Q3 of 2021, these were looking like they were fantastic deals and they'd completely turned the corner. If you look at returns more currently, though, again, every single one of these cohorts for a quarter has turned substantially negative. So it's seeming like they were maybe less different than might have been the case. Again, one of the things I emphasize in my paper is how much redemptions amplify SPAC costs, because most of the SPAC's costs are fixed. And if you have high redemptions, then it's leaving fewer and fewer investors left to bear a fixed set of costs, or at least a mostly fixed set of costs. When my paper came out, people said, oh, redemptions are a thing of the past. We've solved them. They're not going to happen anymore. Any analysis based on redemptions is no longer useful. And they were indeed very low during this period of the bubble. And it's not surprising, because if the shares are trading for $15 at the time of the merger, there's no reason to redeem. But now we're back up and redemptions are roughly what they have been for historical periods. Now, if we look at sort of this cash per share metric, which I think is one of the very most important things about a SPAC, and what I really hope we're going to see regulatory action on to make that clearly disclosed, what do we see in terms of developments? So previously I mentioned it in my paper, I found a median cash per share pre-merger of 570. The mean was actually even lower. It was down to 410. Now, what are some of the factors that are driving that? Some of the most important questions are, how big is the pipe relative to the IPO size, and how high are redemptions? So in my study period, the average pipe relative to the IPO size was 30%. Mean average redemptions were 58%. During 2020 Q4 and 2021 Q1, which was sort of this SPAC bubble period, pipes got much, much larger, and this was a really good thing in terms of improving cash per share, reducing the dilution in the SPAC structure. Pipes went way up, redemptions went way down. We went a bunch up. We were up to about 670 in cash per share. So it's still not great. Well, it's still relatively low. It's still at least a challenging proposition to ask a target company to hand over shares worth $10 in exchange for 670 in cash, but it's much, much better than during my study period. Now, though, as the pipe market is cooling, as the SPAC market is cooling overall, if you look at the 2021's September mergers, you see pipes are starting to go down to 72% of the IPO size. Redemptions are going up. If you look at the merger agreements that were announced in September of 2021, the pipes are even smaller there. We don't know what the redemptions will be, but if they're similar to what they were in September 2021, we're going to be down to 590 of cash per share. So on the one hand, 590 is much better than it was in my sample period. So I think it's reasonable to expect that these newer SPACs will continue to do better on average than the older SPACs. The other hand, it's still a challenging proposition to ask a target company to give you shares worth $10 in exchange for $590 in cash. I think some of the very highest quality sponsors might be able to get target company to agree to that. More likely that the highest quality sponsors are the ones who can attract a really big pipe, a pipe that's as big or maybe 2 times bigger, 3 times bigger as the IPO size. One of my favorite SPAC deals is the Altimeter Grab deal. I don't know anything about the actual underlying company, but there you have a proposed SPAC merger where the SPAC IPO was $500 million. The pipe was $4 billion, 8 times the size of the IPO. Completely blows these averages out of the water. It makes for a very efficient SPAC with a lot higher cash per share, and on average is going to have, I think, a much better chance of doing well by its investors. A couple of other points I'll throw out there. In terms of the SEC's announcements and sort of what role they may have played, a lot of people have said that these warrant accounting statements were devastating for the SPAC market. And I think there may be a little bit of a truth to that, although as Jocelyn said, one of the complicating factors is if you look at this red line, which is new weekly SPAC IPOs, and you look at the blue line, which is where the SEC statements were coming out, the new SPAC IPOs had largely dropped down to their low levels even before the SEC's statement came out. What was driving that? Well, perhaps some of it was sort of the glut of existing SPACs and also This teal line is the price of the SPAC ETF, just a little bit of a rough proxy for how well the market is doing. That had lost about a third of its value over the time, probably dampening demand for SPACs. Now, there's this question about innovation and our SPAC sponsors getting compensation that better aligns their incentives with those of SPAC investors. And in particular, a common feature in SPACs is what's nowadays, which is what's called an earnout, where the sponsor will only receive a portion of their promote in the event that certain post-merger price targets are met. Some people say these are a new innovation in SPACs. I find that they're actually not. They've been used for over a decade or more. And so for SPAC SPACs that merged between 2010 and 2015, about 40% of them had earnouts. For SPAC mergers that were in the first half of 2021, about 30% did. So we've actually gone down a little bit compared to some of the older prevalence of them. Although I think the bigger point is that they've been common in SPAC mergers for about at least a decade, if not more. They at least weren't enough in prior periods to dissuade a lot of these not so good mergers that went through. And we can ask ourselves, well, why is that the case? Why would an earnout? And let me give you an example of a typical sponsor earnout. So for instance, it'll say, maybe at baseline level, the sponsor receives 10 million promote shares valued at roughly $100 million. 7 million will be kept outright. 1.5 million will be awarded if the post-merger stock price reaches $12.50 within 5 years. Another 1.5 million will be awarded if the post-merger stock price reaches 15% within 5 years. So I find that mean and median earnouts cover about 30 to 40% of sponsors' promote shares. So even where you do have an earnout, the majority of the promote is still going to be kept outright for most SPACs, but there's obviously variation. And one of the challenges with earnouts, though, is that they are not able to change the fundamental incentives that a SPAC sponsor is facing. So if a SPAC sponsor allows their SPAC to liquidate, they get zero, they get nothing. And no matter how stringent the earnout is, getting shares that are subject to an earnout is more valuable than getting all of the sponsor's investment canceled. And so if you're thinking about an incentive structure that's going to encourage a sponsor to acknowledge, hey, I can't find a good merger, rather than proposing a bad one, I'm going to allow my SPAC to liquidate, it's hard to see how an earnout, at least in and of its own, is going to change that incentive. Now, another challenge with the earnout is that their price targets are very low. So for instance, over the past decade, the geometric average annual returns for the S&P 500 have been about 12.4%. So if you invest and you get 12.4% annualized and it grows over a period of 5.8 years, which is the mean term for earnouts that were in SPAC mergers during the first half of 2021, it's going to grow to about $20. And so if you've got an earnout that's specifying price targets for success of $12.50 or $15, means you can underperform the market very substantially and still qualify as an outstanding success. Now, it is true you may well be above average for SPACs, but it would still be below the market by a lot. One of the biggest challenges, though, with earnouts is that, and this is from some research that I hope to be having coming out in the next couple of weeks, is if you think about what an earnout is, it's in essence an option-like derivative security. And what that means is that you can have, if you value earnouts, which target companies do when they've gone public via SPAC, their accountants then need to usually value the earnouts and they disclose their methodologies. And I basically use pretty standard valuation methodologies for earnouts and ask, well, how much are they worth in different settings? And so what this plot here shows is it shows how much is an earnout share worth relative to a common share. In other words, how much is a promote share worth, promote share that's subject to an earnout worth relative to a common share based on different price target thresholds and different years to meet those thresholds. And what you see is, particularly as you start getting long periods of time to meet the earnouts targets, the value of those earnout shares becomes very close to the value of an unrestricted common share. Furthermore, if you look at how much is that value of the earnout share declining in response to a scenario where the sponsor proposes a merger that's bad for SPAC investors, what you see is that the earnout shares don't lose value very much more quickly than common shares. So obviously, if you compensate a sponsor with common shares and they propose a merger that drops to $8, shortly after the merger closes, the sponsor loses money. It turns out they actually don't lose much more value in the case of an earnout. Why is that? Well, it's because if you've got a long term for that earnout, there's still a lot of randomness that can happen. There's still a lot of optionality built into that earnout. And there's still a pretty good chance that it can bounce up and pay off. And even if it doesn't, if the company continues to do poorly, the shares that it canceled may end up being worth very little. And so particularly if you've got a 5-year term or a 3-year term to an earnout, what I find is that the value of sponsor compensation drops at almost the exact same rate as it does if you just compensated the sponsors with common shares. Now, if you do have a shorter period, 1 or 2 years to satisfy the earnout condition, I find that they're a lot more successful in actually reducing the value that the sponsor receives if they propose a merger that's not good for SPAC investors. I find the effect is even more dramatic if you compensate the sponsor using warrants. So if you cancel some of the promote shares and give them new warrants that have a short term, 1 or 2 years post-merger, then you get an even more significant effect. Even the best structured earnout, like I said, is not really going to be able in and of itself to dissuade a sponsor from proposing a deal that they suspect will be bad for SPAC investors, because even shares subject to an earnout are better than getting nothing in a liquidation. But if you have an earnout that's coupled with the sponsor making a large investment of their own money and buying shares at $10 per share and subjecting all or most of their promote to an earnout, then you can start getting better incentive alignment. We don't really see that in any of the current SPACs, but I'm hopeful that maybe as time progresses, we'll start seeing that happening more.
Thank you, Michael. So I'm going to turn it back to Jocelyn now. We can start wherever you like, Jocelyn. If you have any thoughts based on Michael's research you'd like to share, or we can turn back to your slides about regulatory scrutiny and sort of how we place the SPAC in the middle of the regulatory alternatives.
No, I think I'd like to really respond to some of Michael's research, because I think it's particularly interesting, and it really dovetails with some of the things that we're doing in practice. Let me start first with with the regulatory piece, so that we don't miss that that component of it. I think with any type of a structure that has the type of acceleration and growth like the SPACs showed, especially in last quarter of 2020 and in 2021, it's going to attract attention. I don't think that there's anybody within the SPAC practice that doesn't want to see SPACs improve and have more and more transparent disclosure. The SEC is clearly already down that path as they've come to really understand the structure even more. The comment process is exacting. I think it's more intense than the traditional IPOs that I'm going through. I do think that the documentation and wading through 1,000 pages is a lot to ask of anybody, and to the extent that we can try to modernize our approach to disclosure and use some of the social media and other tools that we have available to try to explain some of these things, I think it would really enhance investor understanding and opportunities for investors. Because as Michael explained, if you're able to buy the SPAC, and frankly, since a lot of them trade below market value on day one and they still have the warrants attached, if you're able as a retail investor to go in and buy that SPAC, then you have optionality and a built-in gain, as long as you have the financial wherewithal to be able to hold it for the the duration of the SPAC. So it's an investment that and a fail-safe that you really wouldn't have in any other type of investment. You buy an IPO share, right? There's no, in a traditional IPO, there's no ability to go ahead and redeem. In terms of some of the creative things that we're doing to really bridge some of these gaps, earnouts are one, but there are a number of deals, and yes, I'm sure they're a small number of transactions, but you're starting to really see clawbacks of sponsor equity based upon the level of redemptions, right? More and more of the, I'd call them the Generation 6 SPAC sponsors are the ones that are starting to write those, those larger checks and are seeding the pipe portion of the, of the transaction. We did for a long period of time, we personally recommended smaller SPACs and larger pipes. They're certainly more company friendly. They're more investor friendly, but they have to be right sized to the valuation of the companies. I think one of the things that Michael had mentioned too was really this competition for valuation. Those were called SPAC offs, and they did happen. And it was oftentimes in combination with a PE sale of the company, and people were really looking at different alternatives for liquidity, and SPACs were just one of those pieces. I don't see those happening anymore, and I think people have really taken a different view in terms of SPAC valuations and the marketplace generally. If anything, there's a SPAC discount in terms of valuation, and both companies and the SPAC sponsors are really laser focused on helping achieve a company that's going to trade well post de-SPAC. And if you're taking out every dollar in the pre-money valuation, that's certainly not going to happen. It's going to be harder to raise that pipe, et cetera. There's a much more diverse group of pipe investors that people are appealing to. I would say that the initial pipe market is exhausted and tapped out. Frankly, they buying in at $10 suffered a lot of what Michael is showing on in his presentation. So you really are seeing a shift in terms of who the pipe investors are, and going out to new classes of pipe investors with different types of structures and some downside protection embedded into the pipes.
What sort of downside protection are you seeing, Jocelyn, for the pipe investors?
For the pipe investors, frankly, people would like to avoid it. I think you're starting to see pipes split between the pipe and a backstop, and people are paying for the backstop. So it's a transfer of founder equity for the backstop, and then you will start to see downside protection where more founder equity is transferred in the event that the stock price decreases. So you're kind of cost averaging the pipe to the extent that you play in both pieces of it.
And we have a question too. So Dan says he finds the clawback practice to be fairly opaque. He wonders if there's a rule of thumb, for example, percent X of the sponsor's shares should be returned if percent Y of the investors redeem. Can either of you provide some more information on that issue?
It's hard to do a one size fits all because it differs. If you have a SPAC sponsor who's writing an additional check, right, but there are going to be redemptions, it's harder to claw back as much from that SPAC sponsor than a SPAC sponsor who is literally just providing the trust and a listing, right? And to the extent that somebody's just providing the trust and the listing, and both are compromised because of redemptions reduce the trust, redemptions reduce your ability to meet the listing criteria. They all have an implication on one another. Clawing back more so that essentially the dilution resulting from the SPAC sponsor's ownership matches the contribution. So in every deal, that's different in terms of how the operating company values the contribution that the SPAC sponsor is making. If it's purely financial, I would argue that if you have 95% redemptions, you should only retain 5% of your sponsor equity at the end of the day, maybe even less if you've jeopardized the listing. However, if you've provided that you've secured backstops for 50% of the trust, you've written another $100 million check, that's a very different scenario when I would argue that that SPAC sponsor has done their job, and they may be willing to invest in future rounds with the company. They've put on board members who are not just financial engineers, but they're industry experts and have really helped diversify the board and bring needed expertise to the board. We're really weighing all of that when we think about how to structure and what's equitable in these transactions. And the nice thing right now is that for the companies that are signing merger agreements today, we can deal with all of this on the front end, and we can plan for it, and we can adapt structures, and we can adapt IPO structures to address this. The tough part and the deals that keep me up every single night are my clients that sign deals in May, June, and we're coming to close it now, and you're looking at huge redemptions, and it's not the SPAC sponsor. Like in the deals that I'm dealing with now, these are all industry SPAC sponsors who are writing additional checks and who are really collaborating with the company and have worked hard. It's a market issue. We have ARBs that have moved in. The founders in retail left. In March, you see that big dip in Michael's chart in terms of the IPOs. You saw a major shift in pipe money, in part because I can't explain what happened in January and February in the pipe market. Every single deal that I was looking to do happened quickly and immediately, and those checks were just written without the level of diligence that I had seen in the previous 2 years. All of a sudden, we saw a complete 180 when we hit sort of mid-February, where all of a sudden people woke up and said, okay, we need to completely change. And that it's loosening a bit, but we're still seeing the ramifications of that I call it over exuberance in Q4 and Q1 of this year. I don't think it did a service to the SPAC market in the least, and it's triggered the regulatory and congressional inquiry. But those are the deals that keep you up at night, because you're just trying to figure out how you solve it, right? Like, these are companies that are doing great things and that will be incredible public companies. They'll go through a period of time where they probably won't trade well, but over time, I think that each of them will end up being a really successful public company. And it's just going through this piece of it and trying to work to produce the best results it's tough. It's incredibly challenging, and it's I wish I had a silver bullet or a magic wand to deal with it. But I hope that answers your question, because again, there's nothing that's one size fits all in this particular marketplace.
And I wanted to show one chart here of something we thought would be interesting to look at Cornerstone. So let me share my screen. One of the statements that came out of the SEC. So are you able to see my screen now?
Yes.
Okay, great. So some of the SEC statements that came out in this spring noted that when it comes to disclosure for SPACs, be careful about how you portray your forward-looking projections. And are you including only the rosiest projections? Are you including a range that incorporates some potential downside? And what we did in this chart was to take the 2020 year for de-SPACs completed in 2020, and then looked at the revenue projections versus the actuals. So at the left side of the chart in the blue, those are the companies for which their actuals were greater than their projections. And the flip side for those in red on the right, where their actuals were lower than projections. And you have the companies listed on the horizontal axis there. And those company tickers that are bolded are ones that have class action litigation against them at the moment, in part related to allegations about projections, among other types of allegations. And so one of the things that we were looking into is, well, is there a way to look at the characteristics of the SPAC and identify those companies that may find themselves on the left side in blue versus the right side in red? And while this research by us is just preliminary, we didn't automatically find any types of clustering by industry or other type of SPAC characteristic that would be a helpful predictor for those that may land in the right side in red. And I don't know, Jocelyn or Michael, if you have any thoughts on this, or if this is something that you're also monitoring.
From our perspective, projections are even harder these days, right? Because if you think about it, all of the projections are based off a zero redemption scenario. And, you know, you go out, you publish those projections publicly at the time of the, you know, at the time of the de-SPAC announcement, but things can be very different when you get down to actually consummating the transaction. And so, you know, one of the things that we're really working with is going back and doing a deep dive and really looking at the projections and what types of updates we need to make, and also thinking about companies that we're taking out right now, how we position those projections, and do we always, you know, can we any longer just assume that the redemption levels are going to be zero, right? Is that the appropriate? Are we going to have that level of cash? Because that plays into the projections, it plays into the company's business model and what they're able to achieve. I'll also say that, you know, the focus on projections, I think a lot of my fellow SPAC practitioners have become more and more focused on the projections. It used to be the domain of just the bankers, and oftentimes we as lawyers came into it too late. You know, after people had gone out with the projections, sometimes after the pipe had been put together and decks had been published, and you couldn't back off of it. Like the minute that you've gone out to these investors, you don't have the ability to just turn around and say that something's different. Today, companies are a lot smarter, a lot more educated. We push back a lot on the number of years, the inclusion of assumptions. And so I think if you look at, you know, if you look at a deck 2 years ago versus a deck today, for most deals, you have much more granularity in terms of the assumptions underlying the projections, so that you can look at them with a much more critical eye, because projections without the assumptions, from my perspective, are meaningless.
Yeah, I agree with a lot of that. I really, I think more disclosure of projection assumptions would be good. And I mean, from a regulatory perspective, I think the most important thing is we should have a level playing field between SPACs and IPOs. So I think there's a very reasonable case to be made that you ought to open up projections more for IPOs. There's nothing that prohibits IPOs from doing them. It's a matter of practice. They're less common. There's some minor liability differences between SPACs and IPOs. And I think that those ought to be equalized, and maybe that is extending SPAC projections, those same protections to IPOs. Now, in terms of patterns with projections, yeah, it's interesting. It's a challenging area. I'm still myself trying to get my mind wrapped around it. I'll show a couple of things that I've been looking at recently. So one thing I've noticed is if you look further out, if you look at a different period of time, you have some interesting patterns. And so I analyzed all projections for mergers from 2014 through 2020. So overall, they tend to get worse over time the further out post-merger you get. One of the odd things that I've found is even for year zero, the year of the merger, because oftentimes that, you know, has not yet been completed, or even if that year has been completed, the financial results are not in. The projections tend to be pretty optimistic, even for the years that are already done, which is a little bit odder and troubling. I also find, interestingly enough, that if you look at sort of the forecast error and post-merger returns for companies, basically for the SPACs that meet or exceed their projections, they do, you know, about as well as a market return. They maybe slightly outperform the market. By contrast, the ones that fall short of their projections on average substantially underperform against the market. And so what that means, particularly from an investor perspective, is if you're going to buy into this company, you really ought to believe that the projections are real, that you wouldn't want to lull yourself into a false sense of complacency and say, oh, everybody sort of pads them and exaggerates them. And, you know, I think this company will still do fine, even if they only meet half of their projection. You really do want to be confident that the projections are pretty accurate. I find that external analysts who cover SPACs tend to also be overly optimistic in their analyst forecasts in terms of earnings per share. And that's even compared to other newly public companies through traditional IPOs. I also find that the more aggressive SPAC projections are in terms of forecasting a higher earnings per share growth per year and a higher cumulative average growth rate, they tend to be associated with more inaccurate external analyst projections. So it seems like external analysts may be maybe being swayed into overly optimistic predictions based on the projections. And I find that SPACs that have higher costs, in other words, lower cash per share pre-merger, tend to adopt more aggressive projections in terms of projections that are implying a higher average yearly growth per share, higher cumulative average growth rate, different measures of them that seem to line up with more expensive SPACs, which ties in with the notion that they're the ones that are more likely to be overstating the value of the target company going public. So yeah, there's a lot of interesting issues. I think the market is still trying to really get used to how do we interpret this data that's coming from these SPAC projections, and how do we make sense of it.
And projections, you know, having worked with companies for over 30 years, I don't put a lot of credence in projections. You go out a quarter, and no matter how much diligence and everything you did in the projections, meeting those there are always all kinds of variables and changes that come into the micro or macroeconomic environment. So even when I'm looking at whether something's material non-public information because somebody received projections, especially like 5-year projections, you know, that's why you've seen with a lot of the law firms that are really digging into this, they're really looking at, okay, what year is this being based off of, valued off of? And, you know, it doesn't make sense to provide projections beyond that because it's a guess at that point. 5 years out, nobody would have expected COVID and the impact that it's had on, you know, on certain markets. I mean, if you look at some of the EV companies, even, you know, some of the flying taxi companies, look at all the regulatory hurdles people have to pass. Nobody can determine when they're actually going to hit those regulatory hurdles. And as those get pushed out, you're definitely going to be wrong in terms of your projections. So that's why I think the assumptions are so critical here, and the believability of management and why they believe that you know, that projection is accurate based upon the information that they have now, so that you're really digging in and looking at those, you know, at those assumptions. And it's really incumbent upon the SPAC sponsors in the first instance to do that work. You know, that's their role. And then the SPAC, I mean, the pipe market, you know, to really validate it and test and ask the questions, the hard questions. And there are deals, you know, it's happening. It's part of an iterative process where deals are coming back and people are saying, you need to restructure this. We buy in, but not at these levels, and you haven't built enough cushion. There are just too many variables that could really impact your performance and having your performance happen at that time frame. So it's incumbent upon all of us to really dig in and and help our companies use these in an effective way, and really be the ones that are critical. It doesn't, we don't make a lot of friends doing it, at least initially, but on the back end, you see the results, and you have clients that aren't in class action litigation. We don't want to see any of our clients in class action litigation, and so I think it's really important to do on the front end.
Well, thank you, Jocelyn and Michael. I realized we're at the end of our time, so this has been a really great discussion. Jocelyn, you have such a deep expertise. It's valuable to learn from you. And Michael, I can't believe how ahead of the curve you are with all of your research on these topics. We've learned a lot from you. I think you both provided ideas to the audience in terms of potential future topics. I'll note that of course, the SEC has said they may be doing more in this space. And the SEC's Investor Advisory Committee that I mentioned at the beginning of this session, where I'm a member, we did put out a recommendation of some things for the SEC to think about related to disclosure, and then also just sort of documenting participants and incentives in this space. I'm getting thanks from people here as to a very great session. So thanks for coming, and thanks to you both. And I hope you enjoy the rest of the meetings.